Hello and welcome to Money Mindset. The stock market can be a confusing and overwhelming place, but it doesn't have to be. In this video, we're going to take a look at the basics of how the stock market works and give you the knowledge you need to start investing in the market. First, let's talk about what the stock market is. Essentially, the stock market is a collection of exchanges where stocks, or shares of ownership in a company, are bought and sold. When you buy a stock, you are buying a small piece of that company. If the company does well and makes a profit, the value of your stock will go up, and you can sell it for a higher price than you bought it for. If the company doesn't do well and loses money, the value of your stock will go down. The value of a stock is determined by supply and demand. When a company goes public, it issues a certain number of shares of stock to the public. These shares are traded on the stock market, where buyers and sellers determine the value of the stock. If more people want to buy a stock than sell it, the price will go up. If more people want to sell a stock than buy it, the price will go down. This is why you'll see stock prices fluctuate throughout the day. It's a reflection of how many people are buying and selling at any given time. One way to track a stock's performance is to look at its price over time, which is usually represented as a chart. This will give you an idea of how the stock has been performing, whether it's been going up or down, and how volatile it is. It's important to note that past performance does not guarantee future results. When it comes to investing in the stock market, there are a few different approaches you can take. One popular strategy is called buy and hold, where you buy a stock and hold onto it for the long term, regardless of short-term fluctuations. Another strategy is called active trading, where you buy and sell stocks more frequently based on market conditions. This can be a bit more risky, but can also yield higher returns if done correctly. It's also a good idea to do your own research before investing in a stock. This can include reading financial news and analyzing a company's financial statements to get an idea of its financial health. By looking at a company's income statement, balance sheet, and cash flow statement, you can understand its revenue, expenses, assets, liabilities, and cash flow. Additionally, it is important to look into the company's management and its industry sector. This will give you a better idea of whether the company is likely to do well in the future and whether it is worth investing in. You should also consider consulting a financial advisor before making any investment decisions, as they can offer valuable insight and guidance. A financial advisor can help you create a personalized investment plan that takes into account your financial goals, risk tolerance, and time horizon. They can also help you understand the different types of investments available, such as stocks, bonds, mutual funds, and exchange-traded funds, ETFs, and how they may fit into your overall investment strategy. It's also worth noting that diversification is an important aspect of investing. Diversification means spreading your money across different investments, rather than putting all your money into one stock. This will help you spread risk, so that if one investment performs poorly, it won't have a significant impact on your overall portfolio. Additionally, it is important to keep an eye on the market conditions and make the appropriate adjustments to your investments. If you enjoyed watching this video, don't forget to hit the like button and subscribe. Thanks for watching.